In today's world of market volatility and uncertainty, your retirement plans need to be front and center. With ever-changing tax laws, healthcare worries, and an unpredictable stock market, don't overlook the vulnerability in your retirement planning. Protecting your family and estate will be difficult with shifting policies in Washington. It's more important than ever to keep an eye on retirement.
Hi, and welcome into this week's edition of Eye on Retirement, a production of Market Advisory Group. I'm your host, Rick Everett, along with Financial Advisor Jonathon McCoy from Market Advisory Group. And Jonathan, welcome in.
Thanks for having me. Very excited to be here this week.
A lot to cover today, so I'm going to jump right into it. Yeah. As a person is getting ready to approach retirement, how do they determine what mix of investments is right for them in retirement, and when should changes be made if they need to be?
Right, so obviously there's no exact science to this. Even in our industry, I mean, there's loads and loads of research, loads and loads of history that we can look at as far as what might be appropriate. Ultimately, it's a very individual decision-making process. And a lot of people are at the will and direction of their financial advisors, right? And, you know, the traditional mindset being, you're retiring, you've gotten a little older, you should be winding down how aggressive you are with your investments. Well, the traditional mindset around that is less and less stocks, more and more bonds, right? So one of the issues that we come across over the long term is stocks aren't necessarily going to perform, bonds aren't necessarily going to provide a lot of protection in a down market, especially if interest rates start to rise from where we've been, you know, at these all-time lows here recently. So that buy and hold investment management strategy, regardless of what your mix of stocks to bonds is, not necessarily going to be the most efficient way to carry you through your retirement. One way, especially at Market Advisory Group here, that we think about asset allocation when retiring is focusing more around how you're actually going to be using your money, especially during a market downturn. Having a plan for what assets are you actually going to be spending through in different market environments, and then also having an investment strategy that is designed to mold and blend itself with the current market conditions. So as those change, the portfolio is designed to change with it.
So circling back, if a person is planning on retiring at age 65 as an example, then what would be a good time to get with that financial advisor to start making a plan of how to switch things up if need be?
Right. Well, we in our offices, we use the term the retirement red zone a lot, and I don't believe that's trademarked, so it's okay for me to say, but it's a fairly widely used term. But ultimately, it's how you define it. A lot of people look at the last 5 years of your working career and the first 5 years of retirement as that 10-year window where it's absolutely crucial to be fairly certain about, yes, what your asset allocation is, but also what your income need is going to be and how are you going to be looking to control volatility on your assets. But there's really, once again, no exact science to this. And my mindset with the folks that we meet with on a daily basis is it's never too early to plan. We meet with folks that are in their 30s, 40s, 50s, 60s. Sometimes we're meeting with folks within a month or two of their retirement date, and they're just now starting to try to get this plan together. And all I can say is it is much more difficult to get all those pieces in order in the last minutes or last months before your retirement, as opposed to giving yourself as much time as possible. You know, I would say even 7 to 10 years could be appropriate, depending on your circumstances.
We all know that there are advisors out there that are somewhat of the mindset, set it and forget it. So as a client, as a person getting ready to retire, when would that red flag go up? I mean, I've been doing things the same way year after year after year. I'm 5 years out from retirement. My investment advisor hasn't talked to me. So is that a red flag?
I would say absolutely. I mean, we talk about these red flags with advisors all the time that, you know, your taxes aren't being addressed. You've never talked about exactly how much income you're going to need. The advisor's not familiar with what your budget and tax situation is going to be. So it almost puts the advisor in the position where they're trying to scramble things together at the last moments as well. And ultimately, we find that if your advisor is not asking the right questions, you don't necessarily know the right questions to be asking either, until it's right upon you, right when you're ready to retire, and you tell your advisor, "Hey, I'm planning to retire in 6 months." That may send your advisor scrambling, especially from a buy and hold investment strategy standpoint. You know, most advisors, as you mentioned, are sort of set it and forget it, and The issue there being is that can be a reasonably good strategy while you're putting money into those accounts, saving in your 401k, saving in your IRAs. But what happens if the market goes through a prolonged downturn in the first 3 years of your retirement days? And how are you expected to survive on income from your portfolio in that circumstance? If your advisor's not putting your portfolio that they've put you in through the ringer, essentially ahead of time, to show you what the worst case scenario would be if you retired today, then you're probably already too late to put that plan together.
So an ounce of prevention truly worth more than a pound of cure at this point.
Yeah, absolutely. There's nothing better than as much advanced planning as possible. And we believe that should be at the hands of the advisor to be bringing up in your regular reviews.
Now, circling back to the whole buy and hold strategy, it could be something that we picked up from our parents, from an investment advisor we started with, maybe 10 or 20 years ago. But in this economy, in this current political climate that we're in, that's really old school thinking to a large degree, and potentially even dangerous to a person's retirement livelihood.
Yeah, exactly. One of the very, very first folks that, when I got into the industry many years ago, one of the very first folks that I worked with was just reinstating his retirement plan, or his plan to retire, after a nearly 9-year delay. Had planned his retirement party for December of 2007. Well, we were already 3 to 4 months into the beginning of the prolonged downturn that became 2008 and the financial crisis of those years. So, the buy and hold strategy, it flies in the face of how we like to manage our clients' money. Like I said, the portfolio strategies that we put together and use for our clients, it's designed to mold and morph with the market changes, not just say, here's what you get in stocks and here's what you get in bonds. That would be your buy and hold. To prevent at least one, if not two, of these two things. If the market drops, you're either going to lose money or you're going to lose time. Which is more valuable to you? And a lot of people say, most advisors will say, okay, it's down, but don't sell now, just hang on, it'll come back, it always does. The market over time is going to make you whatever they say, 8, 10, 11, 12% rates of return. Well, there's no guarantee of that in the future. Had you invested in the S&P 500 in 1999, you could have ridden all the way until 2009, 10 years later, and actually been down a little over 3 or 4% after 10 years of investing. So tell me how well that buy and hold strategy works.
Right. And of course, the tax implications that come with planning for retirement. We don't do things in retirement the same way we did as we were building that retirement nest egg.
Right.
An advantage of being at Market Advisory Group.
Exactly. I always like to point out that folks that are retiring today, you are the generation that's coming to the end of your working career that is the first to be exposed to this experiment of pre-tax retirement accounts. 401ks and IRAs were not really around for the parents' generation of the folks who are retiring these days. So the assumption is, right, while you're working, you defer paying taxes on all this income until a later date, ideally until you're in a lower tax bracket when you no longer have all this earned income. But when we start looking at tax situations with our CPAs and our team at Market Tax Services as well, we start to see that when you pack on pensions, Social Security benefits, required minimum distributions are a huge thing that are, whether you believe it or not, a little bit more in your control than you might think, but you need the help of a CPA to look at how those required minimum distributions are going to impact your tax situation 5 to 10 years down the road, as opposed to just a tax preparer who is only looking to essentially record history and plug the numbers in to get your tax return done. And a lot of these tax softwares that are out there these days as well are not going to give you tax advice to show you, here's what your tax situation is going to be 5 years, 10 years, 15 years down the road. And here are some of the more proactive things you can be doing today to help prevent unnecessarily high tax rates in those years.
Now, if you're approaching retirement and have questions as you get closer to retirement, or just questions in general about retirement, please check us out online at ionretirement.com. There's a place there where you can leave a question. We also have our operator standing by right now at 316-252-8707. Again, that's 316-252-8707. I'm Rick Everett, along with Financial Advisor Jonathon McCoy, and we'll be back with more Eye on Retirement right after this.
When people work with Market Advisor Group, they get a feel of sense of family. There's a lot of relationships that are made and going on in this conference room, and we really take a lot of pride in that and a lot of satisfaction in that.
Every client we work with, we make a custom-made plan to fit them and help reach their goals in life. And then another thing that makes us unique is we want to meet quarterly with our clients and have reviews.
Market Advisory Group, we have a process, and the process we take people through is first to understand what they have, understand who they are, and then we put together an income plan for them and show them how they can look forward to retirement and not look, though retirement is going to be a stressful time. It needs to be a stress-free time.
A few unique features of working with Market Advisor Group is holistic in-house financial consultants. We've got an in-house CPA, Joshua, an in-house estate planning attorney, Gerald, an in-house Medicare advisor, Bill. We rely on all of those professionals for, again, additional service within our consultative process, making sure that we've got the advice and the expertise behind the recommendations that we make.
You know, as an advisor, I'm not there to sell them one way or the other. I'm there to educate them, to let them know what their choices are. Then I try to help them make the right choice where they can save money and feel confident in their decision.
Absolutely the best part of my job is getting a stack of paperwork from somebody and they don't know what to do, and then I can turn around and give them back a tax return, but also to be able to explain what they can do next year that will give them a better answer than what they had this year.
When we've got clients that are calling and they need to help out a child or need to help out a grandchild or need to help themselves out and they're in a situation they didn't expect to be in, I really relish the opportunity to help them through that, help them make the educated decisions in somewhat stressful situations, because a lot of folks don't have that type of counsel.
We meet with so many people one-on-one in this office that don't ever end up becoming a customer or doing business with us, and that's okay. But when they leave our office, we know that we've helped them either get some answers to some of the questions they had or get some clarity on maybe their own path.
But one of the things that we hear all the time is, I wish I would have met you guys 10 years ago, because how much further could I be down the road? Well, Johnny Appleseed said, when's the best time to plant a tree? 10 years ago. When's the second best time? Today. And so if we can help people today going forward, that just brings an incredible amount of comfort and excitement for us to come to work every day.
Hi, and welcome back into Eye on Retirement. I'm Rick Everett, along with Financial Advisor Jonathon McCoy with Market Advisory Group. And Jonathan, as a person is approaching retirement, a lot of companies, not as many as there used to be, but a lot of companies offer a 401k for employees to contribute into. Some even contribute along with the employees. But as a person's getting ready to retire and leave their job, what are some of the options with that money that they've been putting in for the years into those 401ks?
Well, there's obviously a wide variety of options, and we don't have time, unfortunately, today to walk through all of them, and it's a very, once again, individual decision that needs to be made. But if you're changing jobs or retiring or you've lost your job, whether it's due to some of the labor issues that we've had here over the last several months and years, it's important to understand what your options are. So primarily, people are looking at essentially either rolling their former 401k or former employer 401k to a new plan at the new employer whenever you find a new job, or rolling it into an IRA where you can have a little bit more personal direction over how your investments are managed. That's what a lot of our clients entrust us with here at Market Advisory Group, is to help manage previous 401k accounts that either the employer is forcing them to move or the custodian for that employer plan is forcing them to move. Or else they'll end up paying higher fees, administrative fees, different things like that that the employer used to take care of while they were employed. So once again, there's a wide variety of options, but then we also have to look at the tax implications. How is that money going to be treated tax-wise when you retire? If you're not retiring today but rolling that plan to an IRA, how is that money going to grow, and what is the tax liability going to be on it later? Does it make sense to maybe consider something like a Roth IRA with some of that money where you can get some of the taxes out of the way in the nearer term? So it's not just as simple as saying, where am I going to put this money, but also how am I going to treat it tax-wise?
And for people that have been contributing into your 401ks for a period of years, there's a big difference between a 401k and working with an investment advisor. A 401k is almost kind of like a money babysitter with hopes that it'll grow.
Yeah, essentially. And so I've been working with a client for a number of years now who he was in a fairly large 401k plan with a fairly large employer, with a fairly large, one of the world's largest actually 401k custodian partners, helping to quote unquote manage that plan. But essentially there was no management being done. And part of the reason he decided to work with us at Market Advisory Group was looking back to, once again I referenced 2008 earlier, but looking back to 2008 and what he saw, or I should say the lack of activity or the lack of advice that he experienced in 2008 from the 401k plan itself, from the 401k custodian, he decided he wanted to have a much more proactive approach now that he's that many years closer to retiring, and have something done, have a proactive plan in place in the event that the market goes through a downturn. He doesn't want to experience those 40 or 50% losses that he did back in 2008. So we start to see, we always talk about the definition of insanity, right? You continue to do the same thing over and over again, expecting a different result.
Yes.
When the market crashes again, I always emphasize when it happens. The market tapped us a little bit on the shoulder when the pandemic erupted and shut down the economy for a number of months in a row, but the market remarkably recovered in a very short period of time. The tools that were used that helped propel the market back to the pre-pandemic levels in such a short period of time haven't totally been used up, but the amount of ammunition in the toolbox is dwindling. So when the next correction or when the next market crisis hits, are you sitting there with the same lack of proactivity, or in other words, essentially not having a plan or being a buy and hold investor where you've got an unpredictable floor, you have no idea how low your account value could go in the event of a market crash, and ultimately it's up to you to decide when to pull out. How much loss is too much loss, essentially. These are the things that we're trying to help people establish ahead of time to help protect their assets. It's their life savings, and you only get one shot at it.
Well, and for those of us that were in the market in 2008 and are still here today to talk about it, we don't have all that time that we did back in 2008 if we were to hit a serious bottom again.
Right. I mentioned the story of the gentleman that I talked with you about earlier that was planning to retire in 2007 and had to cancel all of that, and it cost him 9 years of retirement. So it's either going to cost you money or it's going to cost you time. Which of the two are you more willing to sacrifice? And what we find is it's just that people are not being talked to about by their advisors, by their 401k custodians, about what options are available to help protect your money. It's, we sort of blindly go through our day-to-day, paycheck to paycheck, contribution to contribution, and it's just going to do what it's going to do, right? But ultimately, there is something you can do. There is a more proactive plan out there for everyone.
Coming back to the person that is getting ready to leave their employment, whether it's for retirement or other reasons, and they have that 401k, they have the options of either taking all that out in one lump sum, correct? Or having it distributed over months, so much per month. What are the different liabilities as far as taxes go on those two moves?
Well, the liabilities can be massive. Ultimately, the initial and most common choice is a lump sum rollover to an IRA of some sort. And if we're talking about pensions as opposed to 401ks, most people do have a lump sum option versus just taking that monthly payment for the rest of their lives. But especially with a pension, it locks you in, obviously, to that monthly benefit amount. So thinking about not just what is inflation doing today. If you had a $2,000 a month pension, for example, today, and you started that pension 2 to 3 years ago, what could that $2,000 buy you 2 to 3 years ago that it cannot buy you today?
It's going to buy you 20% less today than it did even a year ago,
right,
in a lot of cases.
So these, we hear the term cost of living adjustment in terms of Social Security all the time, and a lot of times it's even a little shy of what we need for real inflation adjustment. But project what has happened over the last 3, 4, 5 years with expenses to the next 10, 15, 20, 25 years of your retirement. A $2,000 pension, not to say it's going to be worthless, 20 years down the road, that might be worth $600, $700, maybe $1,000 in today's dollar value. Are you willing to let your income sources be cut essentially in half as far as how they're going to provide you a lifestyle in retirement simply to get, sort of that guaranteed set income for life? I think inflation is something that is not necessarily being ignored, but it's not being wholly addressed in a lot of retirement plans.
At Market Advisory Group, we're here to help you with your questions about retirement, and we do offer a completely complimentary consultation, whether it's questions on retirement, questions on taxes as they pertain to retirement. You can leave us a question online at ionretirement.com, or you can give us a call. We've got people standing by right now who will take your information and set up a time for a financial advisor to call and provide you with a complimentary assessment of your financial planning as it stands right now. The number to call is 316-252-8707. Again, 316-252-8707. And we'll be back with more on Eye on Retirement right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Hi, welcome back into Eye on Retirement. I'm Rick Everett along with Jonathon McCoy, a financial advisor with Market Advisory Group. And the end of this year is coming upon us so quickly. It'll be here before we know it. And one question a lot of people have been having on their minds is there still time to do anything to help with tax implications for not only this year, but maybe even to adjust things so that tax liabilities are perhaps not as much of an issue next year?
Yeah, it's not too late, but it's soon approaching the time where it's going to be too late, right? I mean, after the end of the year, there are only so many things that you can do to affect this year's taxes, IRA contributions being one of those, or even Roth IRA contributions being one of those. That doesn't necessarily lower your taxable income if you put money into a Roth. But it can help grow some of that tax-free income for the future. What we find, though, is working with a traditional financial advisor, especially those that adhere to these buy and hold style of investment strategies and are not working hand in hand or side by side with a CPA in the same meeting room with you, is these tax issues are not being talked about. It's investments, 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 investments. You're doing okay. Here's what the market's doing. Your investments are fine, right? What we're failing to recognize, and what advisors are failing to recognize simply because they're not licensed to give this type of advice, is Uncle Sam's going to have something to say about 20 to 30% of your retirement accounts. And as I mentioned earlier, this is the first generation retiring today that's been through an entire career as part of this tax deferral experiment. Mm-hmm. Now, some people, I think, we think these 401ks and IRAs have been around forever, but they haven't. I've been working with a gal just over the last several months that her husband unfortunately passed away just a few months back. And one of the things that we quickly recognized is this is the last year she's going to be able to take advantage of the married filing joint tax brackets. So sitting down with our CPAs here at Market Tax Services with Market Advisor Group, we took a look at what were some of the things that she could do. First of all, we had to unwind a little bit of a mess up from her former advisor because he automatically moved her husband's assets into her name. So now next year, her required minimum distribution has doubled.
And that can't be changed at this point.
It's too late after that change was made. And it was simply because the advisor was not working side by side with the CPA. It was essentially a standalone advisor working by himself in an office. She had a 10 to 15 year working relationship with him. They considered themselves family friends. But unfortunately, in this case, the advisor, not being a tax professional or licensed to give that type of advice and not working with a tax professional, it's going to cost her potentially several $1,000s a year in taxes. So we looked to how can we unwind this situation. We had to look more proactively at how could she maybe take care of some of the taxes on those retirement accounts this year while she had those advantageous married filing joint tax rates available.
So the window's not closed yet on trying to make reparations for this year, but it is closing.
Very, very quickly. December 31st is the end date for things like Roth conversions or any income manipulation that you want to have counted in this year. The only thing you can really do after the first of the year is an IRA contribution. And you can only do that up until the time that you file your tax return. So time is running short, and it's important to give us a call and make sure we're sitting down with our CPAs to see what adjustments can be made.
So you can actually do a contribution all the way up until the time you file?
Correct.
Okay.
Yeah.
That's good to know. Good to know. You know, I'd be curious to know how many of our viewers out there actually are knowing what they're paying their financial advisors. Because I'm guessing as you talk to people that come to Market Advisory Group from other firms and ask them that question, potentially not very many know.
No, not hardly any actually. A lot of times people are actually coming to us to ask what they're paying their financial advisors they've been working with for years. And it really seems backwards to me. I mean, you don't go to one grocery store and walk out with your groceries and then go to another grocery store to ask them what you just paid for those groceries or what you owe. So that in itself is a little bit backwards part of our industry in general. You know, the upfront disclosure of pricing is something that as fiduciary advisors we are required to do with all of our clients before they decide on any plan that we put together for them. And we show people plenty of different options, a wide variety of how their portfolio can be managed. But it's important to know what is the mutual benefit between client and advisor before you hire an advisor. And most people are just completely blind to what they're paying.
Well, we're about out of time here on this edition of Eye on Retirement, but we are standing by for your phone call for a complimentary review of your current retirement strategy and to provide answers to any questions you might have, again, at no cost to you. You can call our operators and they'll set up an appointment for you at 316-252-8707. Again, 316-252-8707. Or you can go to our website at eyeonretirement.com and leave a question there. Jonathan, thank you so much for being with us on this week's edition, and we'll be back next week with more Eye on Retirement.
This broadcast is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in the states where it is registered or is excluded or exempt from registration requirements. Registration as an investment advisor is not an endorsement of the firm by security regulators and does not mean the advisor has achieved a specific level of skill or ability. Legal services are offered by Eidelman Law Firm. Tax services offered by Market Tax Services. Market Advisory Group does not provide legal or tax advice. Investment advisory services are offered through Foundations Investment Advisors, LLC. See registered advisor. This broadcast is copyrighted by Market Media Network. All rights reserved. Brought to you by Market Advisory Group. Invested in you. Call 316-252-8707. That's 316-252-8707. Or visit marketadvisorygroup.com.